Hi, mate. I hope you're well. I got myself in a bit of trouble with some debt, about £40,000, so more than a bit of trouble. I'm after some advice and direction in terms of maybe passive income / an avenue to try and work my way out of it. Is there some material I should be reading, watching that you might know of? And I asked him, I said, what kind of debt is it? And he said, personal loans and credit cards, mate. And I said, how I need to ascertain how urgent those debts are and if it's causing any immediate issues. And he said, well, they're not super urgent, but as a result of the high monthly outgoings, I'm a month behind my mortgage payment this month. So it is, but it's not, because I don't want to keep being in that position moving forward. It's costing me circa $1,000, so £800 a month in repayments at the moment, and I can't get a consolidation loan. It's a perfect storm starting because I've just started a new job and my partner is on maternity leave and I have this debt mountain. It's starting to affect my family if I can't pay the mortgage, So I've got to change moving forward and figure out what to do. And you're the man to ask for advice. I was like, fuck me, I'm not And then he messaged me again within an hour and said, hey, sorry, man, if you're busy, just wanted to nudge this. Then messaged again an hour later because I was on a flight and said, hey, I really need some help and direction, man. I'm quickly running out of places to turn.
He's kind of in a hard spot because £40,000 in debt with the interest payments of, let's say your interest rate is 15 to 20%, that starts to spiral out of control a little bit. Like if he was under £10,000 in debt, it's a little bit more manageable. But at $40,000, the interest starts to compound quite quickly. So, you said he had a mortgage. He might even have to consider moving, selling the home to at least get the interest payments under control or reduce that amount of debt. It's kind of one of those situations where you just need to reduce every single expense possible and start really pouring all your money into the highest interest rate debt that he owns. So you can rank your interest rates of all your debts from highest to lowest and start at the very top, right? If it has 22% interest rate, you want to get rid of that first because that's what's killing them. At those levels of debt, it's really tough because I think a lot of people consider bankruptcy at that point just to kind of clear that amount of debt. Depending on what his income is. I've known, let's say, a waitress or a server that had $50,000 in credit card debt and just unable to get over it because the interest payments were as much as their salary. So in those cases, unless you can get a personal loan from, let's say, a family member and kind of clear that debt, you're in a really tough spot. Reduce your expenses as much as possible. Put any extra money you have towards that debt at the highest interest rate possible, the highest interest rate thing, and then consider selling some assets if he has assets.
Bankruptcy. When should someone consider bankruptcy and what's the trade-off?
The trade-off is 7 years. I believe your credit is shot in America. So, but I believe that actually, I think if you pull up a chart, someone sent me a tweet the other day of bankruptcy lawyer searches in America on Google, and it's been kind of going up and to the right, which is not a great thing. Bankruptcy just, there's different types of bankruptcy that you can file for, but I do know that it usually clears some, if not all, your debt, and you basically have to start over. But as a result, you lose a lot of your privileges, for example, no credit score.
I read some stat, and you might know if this is true, but I read a stat that it said something to the effect that people avoid going into bankruptcy because of the stigma associated with it. But when they looked at the financial performance over 10 years of people that did go into bankruptcy, those that did typically were better off than those that tried to avoid it for the next 10 years. Yeah.
I don't know. That could be anecdotal. I don't know. That's tough because if you have $50,000 in debt and you make $50,000 a year, it's different.
Bankruptcy in some ways is a good thing because it forces you to do crisis control. It's your expenditure, what you're doing, everything becomes hyper-focused. You led in the beginning with about, how people should look at their expenditure, right?
Yeah.
When you're $40,000 in debt, you've not been doing that.
Correct.
And bankruptcy actually forces you to actually discipline that for an extended period of time where it becomes a habit. So, Stephen, that's why they outperform in the end, because you've created the habit that you talked about right in the beginning of this discussion.
Yeah, so I just found the stat here. It said, this is one of the uncomfortable truths in finance, and the answer is often yes. Those who file for bankruptcy end up in a better place long term than those who try for prolonged periods of time to avoid it. And the research shows that people who file for bankruptcy typically get their debt wiped out and cleaned, and they removing unpayable debt. And bankruptcy can bring immediate mental relief, removing the crushing stress of unpayable debts. People who avoid it often live in chronic financial stress, which spills into their health, relationships, and work. So in short, those who face bankruptcy head-on often recover faster and end up in a stronger position than those who keep limping along trying to avoid it.
And I think somebody who's listening who may be in a similar or the same situation ultimately wants to know, how do I get relief? Bankruptcy is one option, but at the end of the day, there has to be change. And that change is difficult. And that's the part that I think a lot of people have a hard time talking about or comprehending. There is relief, but it comes with severe, extreme, and quick sacrifice. What do I mean? Number one, you got to cut back your expenses as fast as possible. In that situation, you have to sell as much stuff as possible. I mean, bankruptcy obviously works, but you also lose your house. You also lose other things along with it. There's a lot of emotional toll with it. You have a family, you have a kid. I mean, it's also a big reason people end up getting a divorce. So it can also impact your life in many different ways. So you have to make extreme sacrifices. And I mean, get rid of the Netflix subscription, not because it's just costing you $15 a month, but because the average American is spending more than 2 hours a day watching Netflix. And if you're in that type of situation and you're spending 2 hours sitting there watching whatever the heck is on Netflix, how do you sleep at night? You shouldn't be sleeping 8 hours a night. You better be getting up, go and try to get some more money. I don't care if it's Uber. I don't care if you're working at McDonald's. Find some extra money and learn how you can earn some more money. And I mean, it sounds harsh, but the reality is if you want extreme change, it's not going to happen without extreme change.
So could he sell his house, do you think, that assuming he's making the 50K, which I think is probably accurate, having a vague understanding of his job and where he lives, etc., sell his house and then move and rent an apartment? Would that free up capital?
I mean, that would alleviate his current problem immediately, sure.
He says here, after some advice, direction in terms of maybe passive income. This word passive income, I know.
It drives me nuts.
Why does it drive you nuts?
There's like a passive income industrialization complex that is, I mean, it is literally every millennial's dream is, I'm going to get passive income. And it doesn't exist. We talked about property. Property is the least passive income you can imagine. It is awful. Every time I've tried to rent out property, there are so many costs. Everything goes wrong. It's just endless. You're paying fees. And people think there's a magic passive income. Everything comes with effort. There is no such thing as returns without effort. Well, even robbery comes with effort. You know, there's no way of making money without effort or risking something. And so when you're 40 grand in debt, how on earth do you think passive income is going to rescue you? But he's seen that on TikTok and on Instagram. Oh, we're millennials in our 30s and we're now living in Lisbon and we've got passive income from our house. It's bullshit. It's social media dream that doesn't really exist. And that's never going to save him from £40,000 debt.
Passive income can exist. The perception of what it is the problem. I am struggling with money. I have no money. I got bills to pay. I need passive income. Well, that's not how it works.
That's not how it works.
Yeah. The way it works is you take extra money, right? I'm going to work and I'm saving and investing some money. I take the extra money that I want to put into my investments and I can put it into an asset, an investment that can pay me for owning it without actually working, without going to work to own it. Now, let me ask you about your real estate because I gotta keep coming back to you, man. Did you manage your real estate yourself? Or did you have a management?
I've done both. Okay. I've had management agent and a management myself.
Managing yourself is probably a absolute nightmare.
It's horrific.
And managing it with a manager was also probably a nightmare, just in a different scene.
Yeah, and because your yield is massively reduced as well.
It is reduced.
And then you take the trade-off between whether you're going to do short-term lets or longer-term rentals. And there's the volatility in the short-term lets that you don't know what your yield's going to be. Long-term, different as well. Then you've got the tenants and how bad the tenants have been and the damage that they've done. Yep. And by the end of it, you walk away and think, really, it just wasn't worth the effort.
Well, I would disagree with the end part.
Yeah, I mean, obviously people can do really well out of property.
The work in real estate investment is learning the process. When I first started investing in real estate, it was a complete nightmare. And it was not passive, anything close to passive. It was a nightmare. what you don't know when you start is that there's a good property manager. There's also a bad property manager. How do I find good property managers? By going through a lot of bad property managers and learning that process. And that is a painful process, a very time-consuming process. But when you do have the right team, it can be extremely passive. So I invest in real estate.
What kind of properties are we talking about?
Single-family houses and multifamily apartments.
And do you have lots of them?
Not lots, but I have a decent amount.
And how much of your portfolio is in buying properties and then renting them out to families?
50%.
And what have your returns been like over year over year for the last decade?
So the way I look at returns, when I look to acquire a property, is I want 7% cash on the money that I put in. So when I look at return, I don't care about equity. We talked about this kind of a lot, that if I buy a house for, let's just call it $100,000 and it goes up to $200,000, I don't care. My goal when I acquire real estate is not to sell it and flip it for a profit. My goal is to grow the cash flow that I'm generating month after month after month.
From rental payments.
From rental payments.
It's really difficult though, because someone that hasn't done a lot of property rentals and stuff like that, the chance that I'm going to fuck up
Absolutely.
is so high.
And I'm one of those people, and I probably screwed up more than I can count. It has cost me a lot of sleep, cost me a lot of stress.
So you have to kind of be an expert.
You don't have to be an expert, but you got to be willing to give. In the beginning, right? For the first number of years, it was extremely painful. But today, when I go and I acquire a property, I will look for the property, just like I do research on a stock or whatever I want to do. I do the work to research a property. In today's economy, it's much harder, not impossible, to find those returns. Acquire the property, hand over the keys to the property manager, give them the goals, and now I oversee the manager because I have a team now that is...
It's a business.
It's a business.
It's like starting a startup.
But it's not like starting a startup.
Why?
Because starting a startup, when I work in my company, I am working in my company and I work a lot of hours. So I'm meeting with my employees. I'm leading the meetings. I'm coming up with ideas. I'm leading the vision. With this, I acquire, I hand over the keys. I've already set the framework and now you are doing the execution.
That's a mature business. With my company, there's hundreds of people in the UK right now.
But you're not the one that's starting that startup.
I was the founder.
And now what have you done? You've acquired more employees to get there.
Which is what you did with your property managers.
It's much harder to do that with a startup though. How big does a startup have to be in order to be able to displace you as the CEO, to pay for the staff, to make the money, and then to hire a new CEO and to lead it the way?
Depends. My friend Ash, who was just with me last week in LA, has 4 people in his startup. He's out in LA right now, in my house in LA with my girlfriend and my other best friend who's still there. And I watched, he's in the hot tub right now. I know that because every day at the same time he goes in the hot tub. And then they go for this hike and my girlfriend sends me photos. What he's done is he set up a team of 4 people. They do personal branding on LinkedIn for people and they're running it back for him in the UK. He's up in bloody the mountain with my girlfriend right now.
That's beautiful. But how many startups don't get there?
No, but I'm
people
saying,
that start a business,
when you described it to me, I was like, oh, it's just a business. So
it is a business.
A steep learning curve to develop expertise. And then you put systems in place to make it sustainable.
But the systems are kind of pre-established where you need to rent it out. You need a good manager who's going to find a good tenant. They got to pay the bills. And it's not like a startup where I have to innovate and create an idea. I don't have to go out and build the blueprint. I am going out, I'm acquiring an asset that people already need. It's already existing. Mm-hmm. And then I'm going to put use to it by having somebody live there or use it. And then there's a team just maintaining it.
So what do you think then in terms of passive income? And is it real? But specifically, let's do this point of housing. Do you advise people to buy rental properties and then generate rental fees from them as a source of income? Well,
you just heard Jaspreet at how much work it would take. So I generally don't advise people to get into that business just because of the steep learning curve. And not everyone is built for that. And not everyone has capital for that. So if you're just trying to get started and actually make some money, I just think the stock market is the most liquid and easiest place to get started. I personally rent, and I plan on renting and just instead investing the difference of what my mortgage payment might be in my rent. I think on the coasts like San Francisco, New York, I think that Miami, that might actually be the more reasonable thing to do.
I was reading a New York Times article that just came out yesterday, and it said more millionaires than ever are renting in the United States, and that it's tripled between 2019 and 2023. So in just a couple of years, millionaires are choosing to rent more than ever before. What's going on?
My guess would be a lot of the millionaires are probably living on the coast because they invest a lot or they have higher paying jobs. And maybe it's slightly unaffordable for them to buy a house in, say, San Francisco, Seattle, New York, Los Angeles.
In the New York Times article, it says they're choosing flexibility and liquidity over ownership. And they don't want to be bothered with the inconveniences of home ownership, which includes paying a real estate tax and insurance, especially in markets like Florida and California, where we're seeing a lot of natural catastrophes.
Yeah, so the US is a peculiar market because there's this high real estate tax in owning real estate. Mm-hmm. So all the time your returns are being reduced by that you pay. So whether it's like 1.5% or 2%, whatever the number is, there's that. And then there's the other real estate taxes that come on top of it. Interest rates have been high. They've been high for a while now. So a lot of people have just been priced out of the market just in interest payments. But now, because of mortgage payments are here, the difference is actually with the rental is a lot of rental people aren't trying to cover a mortgage costs because they own the property outright. So you get cheaper rates. So it's to do with price. The US economy's not been super strong yet. At Main Street level, Wall Street's had a great period of time, but Main Street hasn't. So people don't have excess earnings yet. So I think it's a function of that, but it's probably a larger trend as well.
I think also it's understanding what the opportunities are. I mean, there's a lot of flexibility with renting. I mean, I finally bought a house in 2025. I've been renting before this.
So you bought your first property to live in with your family this year?
Yes, me to live in was 2025.
Why didn't you do it sooner?
Well, because when I was renting, I could take the capital and buy other rental properties, buy other investments. So it was it made more sense for me to put that money to work somewhere else.
So is buying a property as a means to generate wealth a terrible idea?
As a means to buy it for yourself to live in or to?
Well, but when I grew up, everyone said to me that you get money, get a job, then you get a mortgage. And so that's what you did.
That's one of the worst pieces of advice you can give somebody.
But that's what everyone's doing. That's still what the vast majority of people are doing. And I know that because I look at my friends that don't have the same financial advice that I have from like my brother and my financial advisors, my accountants. And the first thing they do when they get a bit of money is they go and get a mortgage. And that's because that's what their parents did. And that's what everyone's always done. Is that a good idea, Raoul?
Yes and no. No, I think these days with how the economy's been set up, don't forget, when I was 24, 25, I was working in an investment bank. I wasn't the highest paid guy there. I was a 25-year-old. And to buy my first flat in London was 3.5 times my income. That equivalent flat and the equivalent income is 12 times. So rent makes much more sense now, and you might as well invest. Buy all the stuff that you think will drive returns. But a primary house is not an investment, never will be. Because once you buy it, you don't sell it. You don't realize the equity. Maybe your kids do, if you've got kids. So it's not an investment, but it can be an investment in your future.
But there's like some optical illusion going on here, because when I think about renting, I go, well, that money, I never see it again.
I know.
But with buying a house, I'm paying into it. So it's like me depositing the money in a piggy bank. So logically, of course, renting is wasting money. It goes to someone else and never see it again.
But that's not exactly true. If you go out today, I buy a $500,000 house. I put 20% down. So I put $100,000 down. I finance $400,000. I get a 6.5% mortgage. 30 years. My mortgage payment is $2,500 a month. Now, what am I doing? I'm not renting. I'm not giving money to my landlord. I'm building equity in my property. But banks also understand the same game. They front load your mortgage. What does that mean? When I pay $2,500, it's not $1,250 going to principal to build equity in my house and $1,250 for interest. It's
principal being
buying your house back for yourself. It's not half and half. It's almost all interest. In fact, if you go out and buy the $500,000 house today at a 6.5% mortgage, 20% down, for the first 20 years of that mortgage, more than half of that payment is going to go directly to your banker's pocket with interest. It's not until you're 21 that half of your $2,500 payment is going to go towards equity in your house. So it's all interest, zero equity, and then slowly it moves like this. It takes 20 years to get there. And then what happens along the way for a lot of people, for not everybody, for a lot of people, is along the way, Interest rates go down. I need some extra money. So what do? I refinance. As soon as I refinance, that amortization starts all over again. And so now I'm paying all this interest again, and my real equity that I'm building is not there. This is why I say it's not bad to buy a house. I think it's great if you buy a house, but don't treat your house like you said. Don't treat your house like an investment. Treat it like an expense. Buy it because you can afford it, because you want it, because you're ready, but not because you're going to build wealth.
What do you think? I agree with both their takes. I think that a home is an asset that you can't sell very easily, so that's also a good thing. Like if you have $100,000 to put into stocks or $100,000 to put on a down payment, and you were just such an emotional person that the moment that the stock market goes down 2%, you're selling, probably better to buy a house, right? You can't really sell your house in the tap of 2 swipes. But in terms of an investment, it's like, usually it's much more than an investment to people. They buy them for psychological reason or emotional reasons or the sense of security. So I would just say, like, if you're interested in buying a house and you can afford it, then that's great. Yeah.
And let's actually go with the best case scenario. So like, I think you were mentioning this. I buy a house for, let's call it $500,000. It goes up in value to $1 million. Oh my God, I'm rich, right? Well, it's invisible, but yeah, I could take a cash out refinance, but now I had to pay all that. But here's the problem. You now own $1 million house. What does that mean? You have to pay property taxes on $1 million house. So you got to pay a lot more property taxes. You have to pay insurance on $1 million house. And so now if you pass this house down to your kids, great, they got $1 million house. But if they can't afford the property taxes or the insurance on $1 million house, now they have to sell it.
Insurance is one of these really hidden costs that you don't realize. Particularly if you're in a hurricane area like Texas or Oklahoma or something, suddenly your house insurance costs are prohibitive on top of the taxes you pay. People don't think about that.
So Jaspreet, you're saying buy Bitcoin, right?
Go all in. You're one coin away from everything.
Zero cost.
They've just clip that. That's gone viral.
If you love the Diary of a CEO brand and you watch this channel, please do me a huge favor. Become part of the 15% of the viewers on this channel that have hit the subscribe button. It helps us tremendously, and the bigger the channel gets, the bigger the guests.